NIO stock has been crushing it lately. It's up 127% in just the past 6 months. But keep in mind, this company's all-time high is still around $61 per share. In today's video, I'm going to do an in-depth analysis of NIO. We'll look at the fundamentals, the balance sheet, some key statistics, and finally, I run my DCF model to estimate NIO's intrinsic value and potential future returns. NIO's revenue has grown incredibly fast, going from 4.9 billion Chinese yuans to around 69 billion yuan today, which is roughly 9.7 billion USD. Analysts expect this strong growth to continue, projecting revenue to reach 125 billion yuan by 2029. That represents an average annual revenue growth rate of about 22.75%. Now, the main issue with NIO so far is profitability. The company still isn't profitable, and in fact, losses have increased over the last couple of years. The good news is that gross margins have recovered since their 2023 dip, and they currently sit around 10%. Analysts expect NIO to reach profitability by 2028 and potentially earn $1.40 per share by 2029. If we assign a 20 PE to the company then, that would make it a $28 stock, which represents roughly 278% upside from current levels. So potentially huge returns if those projections play out. NIO's vehicles deliveries have also been impressive, hitting a record of 248,000 units recently. In the third quarter alone, they delivered 87,000 vehicles, which is an all-time high. On top of that, NIO signed a deal with CATL, one of China's largest battery manufacturers, to expand its battery swapping network. This is a big deal. It helps solve range anxiety and cuts charging wait times, giving NIO a real competitive advantage. The battery swap model makes NIO stand out from other EV makers, since drivers can simply swap their depleted battery for a charged one instead of waiting to charge. So overall, the fundamentals look solid: strong revenue growth, improving margins, and record deliveries. But the key question now is NIO stock trading at a good price to deliver strong results? To answer that, I use my DCF model to estimate the company's intrinsic value. I did a 7-year analysis with the bear case, middle case, and bull case, and the intrinsic value according to my bear case is $2.3 per share, middle 6.6, and high $14 per share. And because the stock is currently trading at $7.5 per share, this means that if my low assumptions occur, you will get a negative 8.5% annual return on your money, middle positive 7.8%, and high 21.2%. As far as my assumptions, I assume NIO grow revenue between 10 and 20% over the next 7 years annually, averaging a profit margin and free cash flow margin between 2 and 6%. This is the hard part about valuing this company, as they haven't shown profit yet. And I also assigned a P/E price to free cash flow at the end of the 7 years of 18, 20, and 22. And if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use, as I've done all the calculations in the background, so you only need to plug in your assumptions. Moreover, NIO is currently trading at a price to sales of 1.63. The price to sales ratio is a great metric to compare companies within the same industry. When we compare NIO to Tesla, which trades at a price to sales of around 15, NIO appears much cheaper. However, I personally believe Tesla is overvalued and also is a much more mature company. On the other hand, if we compare NIO to a company like Ford, which trades at a price to sales of 0.25, NIO looks relatively expensive. One thing I really don't like about NIO's financials is the steady increases in shares outstanding. They've been issuing a lot of new shares over time, and I hope they stop doing that. It's bad for investors because it dilutes ownership, meaning you own a smaller percentage of the company and future profits are spread across more shareholders. In conclusion, I think NIO has tremendous potential as a company. The business model is innovative and the growth is undeniable. However, at the current valuation and with the ongoing share dilution, I believe the risk-reward ratio isn't attractive enough right now. So for the moment, I'm going to pass on this company, but I'll definitely keep it on my watchlist for the future. I hope you found this video valuable. Let me know what you think about NIO stock in the comments, and I'll see you in the next one.